All right, so now that we've calculated 3 depreciation methods, and we've also spoken about acquiring assets in class, we're now going to talk about disposing of an asset. So when you dispose of an asset, people are going to give you money. You're going to sell it. You're either going to sell it for more or less than what your book shows. And that's why that book value is really important. And let's begin with that. So when we talk about book value, okay, we're talking about the cost minus accumulated depreciation at any point in time equals book value. All right? So there are 3 rules, or guidance, I guess is a better way to talk about it, when it comes to taking a look at selling my asset and if I have a gain, a loss, or if I break even. And these rules kind of go like this. So if the cash received is greater than book value, you have what we call a gain on sale. Okay. If cash received is less than book value, then we have a loss on the sale. Okay. If cash received equals book value, we have a break even, okay? Which means we made no money at all right? So when you have a gain and a loss and even a break even, when you've entered into an agreement to sell an asset, you need to record it using a journal entry. And I'm going to show you how to do a journal entry using an example problem on page 208. So we're going to be looking at page 208. So page 208, number 10. All right. It says Crispy Chicken sold one of its used deep fryers for $5,000. I always think, oh, yucky, that deep fryer has to be just disgusting with all the grease on it. The original cost of the fryer was $15,000. Okay, so we're going to do cost was $15,000. The accumulated depreciation to date, that's very important because you might be asked to compute depreciation for the asset because you sold it mid-year. So you may need to bring that depreciation up to date. So it's very important that you understand it has to be the most up-to-date accumulated depreciation. At the time of sale, in their instance, is $7,000. So that means that our book value is $8,000. And then it goes on to say that they sold it, so the cash we received was $5,000, right? So right here we go over here and we see cash received is less than book value. So that means we have a loss of $3,000. All right? So how do I book that entry? We first need to show that we got the cash. So we're going to debit the cash for $5,000. Okay? We then have to remove the equipment from our books because we no longer own it. And so that was $15,000. The original cost needs to be credited off the books. And therefore, you also have to zero out the accumulated depreciation that went with this equipment. So in this case, it's $7,000. Right now, if we stopped, your keen eye and knowledge that debits must equal credits, you can see I don't balance. And I don't balance by $3,000. And I need a debit for $3,000. And this is an account that we call loss on sale of equipment. Okay? And now you can see we do balance. Our debits and credits balance one another. All right? So first step, record the cash, remove the equipment from our books, and its associated accumulated depreciation. And then depending if you have a loss, a gain, you'll need this additional entry. These 3 entries will always be done when you dispose of a piece of equipment. So if by chance we had done this a little different and cash was, instead of $5,000, cash was $10,000, then our cash is greater than our book value, right, by $2,000. So that means we then have a gain on the sale. This entry would remain the same, except now we're going to need to, would remain the same with the exception of the cash now needs to become 17. And then the gain is a credit entry, like revenue. Remember, revenue, increased revenue is a credit entry. Well, gain is revenue. I mean, it is income to us, gain on sale. And then our balance number then becomes 17 opposed to the 15. All right. And these numbers here at the bottom are just a double check that I make to make sure that my debits and credits equal one another. And so that is how you show the disposal of an asset. You need to take a look at the cash received versus the book value. If it's greater than book value, you have a gain, and your entry would look like this. If it's less than book value, then your entry looks like our previous example. And if your cash equals your book value, then you're only going to have this as your entry, okay? Because the equipment would not be 10,000 cash, right? If the cash received is equivalent, then you would receive $8,000 of cash. All right? That is disposal of equipment.